Thinking about investing in real estate? Well, let me tell you the tax loophole to get you past only being able to deduct 25,000 in losses or having to become a full-time real estate agent. The loophole lies with short-term property rentals. You can potentially deduct real estate losses against your W 2 income with a short term rental. You also avoid self employment tax and you don't need to qualify as a real estate professional to do it. So let's jump in. But here's the catch: your property must meet two critical rules to unlock the tax benefits. Rule number one: if your guests stay for 7 days or fewer, the IRS does not consider it a typical rental activity. It's now in a different category, more like a service business without the extra taxes. Rule number two: you must be actively involved in the rental. Means you're doing things like communicating with guests, handling bookings, coordinating cleaning or repairs, basically managing the day to day. If you meet both rules, you could potentially deduct 100% of your short term rental losses against your W 2 or your business income. This can be huge, especially in the first few years with depreciation and startup costs. To stay compliant with this strategy, you must document everything. That is the key to being audit ready for anything. So, here's what to track: guest stay logs. Keep a record of every reservation, dates, guest name, platform used like Airbnb, and how many nights they stayed. This proves your 7 day rule. The participation log: maintain a material participation log. This can be a spreadsheet where you record the task performed, the date, the hours spent, notes or receipts like messages or service calls. The IRS wants to see that you, not a property manager, are in the driver's seats. Number three, keep receipts and proof of activity. Save screenshots of messages with guests, maintenance receipts, photos of repairs, or anything that proves that you were involved. Now, let's talk about some further audit proofing tips. If the IRS audits you, and yes, short term rental strategies are a growing audit target, these steps will protect you. Number one, keep a time log. Use Google Calendar or a spreadsheet to log 500 or more hours per year if you want to show significant participation. Number two, separate bank accounts. Have a dedicated bank account for your short term rental. It shows your activity is a real business, not a hobby. Number three, avoid property managers if possible. Using a full service manager makes it harder to prove material participation. Do it yourself or co hosting setups give you a stronger tax position. And finally, keep an annual summary sheet. At year end, summarize your total guest nights, total personal use, if any, total hours worked, and key expenses. This makes your CPA's job easier and helps it if you ever need to defend your position. Be organized. With the 100% bonus depreciation rules back in play, thanks to the new tax bill, you can really rack up in write offs, especially in your first year. You can write off the total cost of the property that you purchased and and pair that with a cost segregation study where you assign costs to individual portions such as furniture, appliances, renovations, and you can accelerate depreciation even more. We're talking big tax write offs, huge. Take that massive paper loss against your income. Boom, instant tax shelter. Just to recap, short term rentals can slash your tax bill, avoid self employment tax, and create massive deductions in year one, but only if you document and structure it correctly. If this was helpful, hit that subscribe button and let me know in the comments. Are you planning to use the short term rental loophole this year? Let us know if you need help. Visit us at thetaxfreestrategy.com. Don't forget, like, comment, and subscribe.